Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Monday, November 4th, 2024. Today's episode, we will start, because it's Monday, I won't forget this time, the daily reminders on Daily Reminder Monday. Things that you should not be forgetting about on a daily basis, even though they are easy to forget about. Daily reminder number one, the 2-year, 10-year Treasury yields were inverted for over 2 years. Not just inverted, but inverted deeply and not even becoming reverted for even a little bit. This by itself alone, without any other clue out there, is screaming that there is a recession coming. And we recently just had our bull steepening reversion on September 6th, 2024. This is when we are expected to head into the worst of the recession pretty much imminently, though we are still waiting for the 3-month 10-year to revert, but that should be happening within the next few months. And we'll get there when we get there. The SOM rule was also triggered in July 2024, suggesting that although unemployment has been coming in, reported anyway, as being low, it has been rising at a pace that suggests it's unsustainable. And every time this rule has been triggered before, it said that we basically are already in a recession or right at the beginning of a recession, with the S&P 500 PE ratio being at 29 and the CAPE ratio or Shiller ratio being at 36, with no major earnings contraction. So companies haven't even started to really see lower earnings. And these metrics are saying that the price is relatively very high. It suggests that the S&P 500 is extremely expensive. This is probably why Warren Buffett himself in his fund has something like $350 billion of cash. Just Googled it, $325 billion. So that's the equivalent of you or me having, it's 1/3. It's 1/3 of Berkshire Hathaway is now currently sitting in cash. 1/3 of an investment fund. If that doesn't tell you something, well, I guess you know better than him or me. Notably, rate cut cycle just began on September 18th, not with a mere 25 basis point, but with a strong 50 basis point cut, suggesting that the Fed started the cutting cycle with saying, hey, we're kind of scared here. And they announced also that they are looking at 50 basis points more of cuts for the rest of 2024, being one cut coming up later this week and the other cut being in December. I just want to throw in here that, they specifically, purposefully don't want to be disruptive of any election things, which is happening tomorrow. And then the Fed decisions comes out on Thursday. And so this could be a very interesting week for financial markets. But I digress. To finish the daily reminders as it stands now, we might need to update these things later this week, by the way, but as it stands right now, the 3-month 10-year is still inverted, although we are headed towards reversion. And when this does revert in a bull steepening case, it typically says that we are indeed already in a recession, like definitely we are in a recession now kind of a thing. And despite the Fed saying in their meeting when they did this 50 basis point cut that they did not want to see any further weakness in the labor market. Oh, really? Well, the Fed is still restrictive and still calculated to be restrictive at least for a few more months. What it means is that the Fed is still strangling the economy. The Fed right now, today, still has its hands around the neck of the economy. It won't last very much longer, because with the next cuts coming in and then the cuts that are expected to follow, that's when we'll finally see that reversion. And that's when the Fed is going to be in a position where they'll be actually supportive of the market in some ways, in terms of the yield curve structure, in terms of inflation, though, whenever the Fed funds rate is above the official inflation rate, which is around 2% right now, basically, that's also considered to be restrictive in some sense. It's considered to be very accommodative when the Fed funds rate is actually below the inflation level. So we have a ways to go before we get to that part. But just on a yield curve stance, we're still restrictive, but this will be changing soon, and not for the better. When the Fed needs to turn the money printer back on and get things going again, it means that the ship is turning the wrong way. We're headed into kind of a glacier or something, and we're trying to turn the other way. So the crystal ball reading remains. I added one piece to this, that the S&P 500 currently priced like a Ponzi scheme. That's how expensive it's at right now. I believe strongly, with my crystal ball and all, that there's a bear market coming imminently. And I believe also that the Fed won't be cutting this cycle fast enough to save the economy. As some people suggest that having an enormous amount of debt limits the actions of the Fed's ability to control inflation. Well, guess what? It's the same thing on the other side, folks. I don't know why this argument isn't being brought up more frequently, but when you have hikes and they're less effective to bring inflation down, well, when you make cuts, it equally will have a similar effect to not speeding up the economy as quickly or as well as people expect. And not only that, with going through recently a high inflationary period, the Fed now has something, a little minion on its shoulder saying, hey, make sure you don't let that inflation come back. They're not going to cut fast enough. If anything, my opinion is, with my crystal ball, is that they will actually cut too slow on purpose and actually let the business cycle flush out more bad credit this time, maybe more so than we've seen in the dot-com bubble or the great financial crisis. Maybe to save the dollar, actually. It would make sense, actually, for that all to happen. But remember, folks, no investment advice on this channel. I'm just a guy with a crystal ball, and it's not even real crystal. It's glass. Next on the agenda, election. I don't know if you've heard in the news, but there's seems to be an election tomorrow. And I've just been blown away at how many people are using like history to say, oh, well, this is what happens before the election. This is what happens after the election. This is what happens in the first 6 months of the election of a new guy or an old guy. And I mean, okay, yeah, that's all fine and dandy. My whole take on the seasonality aspect of these things is that it is an effect and it has pressure, but it won't dominate things if things, there are things that can leave the control of seasonality, let's say. For example, if the Fed comes out with a 50 basis point cut after the election, or maybe no cut, and they say, that both of those scenarios could really throw things off. I do have a crystal ball. So because I have a crystal ball, most likely I'm thinking we will stick to what the Fed funds is pricing in, which is a 25 basis point cut. It's what the Fed has been saying they were going to do. With this recent data, it has been mixed, right? Like we haven't had crazy bad unemployment rate. Although the last jobless claims being only 12,000, that was a big one for me. That was like that was a real that was a black swan event for me, honestly. And the media is saying it has to do with Boeing and the hurricane. I don't believe that for a second. One other thing I want to add about the election is that whenever, by the way, trading technique is adopted and used by enough people, it becomes completely ineffective, because what happens is you have everyone chasing the same trade, making the potential profit margin thinner and thinner until it disappears completely. And so, and it's a similar idea to having too many people on one side of the boat. And so, with election predictions involving where markets will go, I'm not touching that with a 40-foot pole. I'll stick to what I know and can do and can handle. But if you're betting on anything regarding the election, best of luck to you. Last note of the day, Thursday, very notably, we have the FOMC decision. Again, we're forecasted to have another 25 basis point cut. It's what they said they were going to do in the last meeting. And so we should probably expect that to occur. We also have initial jobless claims. It being so unbelievably low in the last reading of this, I'm very curious to see what this number will come out as. As it is, we're expecting, I think it's 200,000, which is a medium number. So we'll see. Another thing for me specifically on Thursday is Nissan earnings. It's the only stock that I am currently actually invested in as an investment, because their balance sheet appears to me to be in a situation where if the company were to liquidate tomorrow, I would actually make money on owning the stock, which to me is a Graham. That's a Benjamin Graham, cigarette butt, blood in the streets kind of stock. Maybe I'm reading into it wrong. I don't know, but they have an earnings report coming out on Thursday. I'm not sure the news or the perception of Nissan could be any possibly worse at this point. So I'm expecting a large increase of the price of Nissan stock to happen on Thursday or Friday. Again, this is a Japanese company, and so I'm not sure what time the earnings come out, but the price will be skyrocketing or dropping to, I guess, zero at this point, depending on how these earnings come out. We will jump into the charts momentarily, but before we jump into the charts, quick thank you for watching, and thank you for all of the support. Support the channel any way that you please. We'll start by taking a look at the U.S. Treasury yield curve. You can find it yourself, ustreasuryyieldcurve.com. I check it on a daily basis. I very recently found it very notable that the 4-month dropped below the 20-year. This end on the left side will be dropping as we revert to a normal state again. Usually when you lend your money to someone, you expect a higher rate of return for the longer that you lend it for. And so in normal good times, the right end of the chart should be generally higher than the left end, and we've been inverted. That's what an inverted yield curve is. And then the other thing about this to really watch is the 3-month and 10-year. When the 3-month drops below the 10-year, that's typically, we are actually in a recession now, because the Fed needs to keep policy low enough to help, things move forward at this point. We're clearly trying to get things going again at that stage, at that point. One other part of the curve I just wanted to bring up today was the 1 year and 10-year. Notably, the 1 year is now below the 10-year. And so the market is expecting for the front end to be coming down below the 10-year, which is very important. The 10-year is involved with a lot of business lending. It's one of the main metrics of borrowing costs that people will use. TNX, you can look up the chart by itself, the 10-year note yield. Anyway, it was actually sort of recently where we have the 1 year now below the 10-year. So within the next year, we're expected to have rates below, to get back to a reverted state. Moving on, we have the SPX, which is the S&P 500 index itself. When going sort of sideways within this large red candle, we're basically going sideways here. The market is nervous about what's going to happen with this election, and so it's just nervous right now. I'm currently still holding my short on SMH. I'm holding the fund SOXS at a very nice gain so far, and because of the structure and the pattern and the overvaluation of semiconductors in general right now, along with some earnings reports coming out that if they do not show enormous strength in the semiconductor industry, it would make $1.5 million for this market to roll over here. It would not be difficult for the value of these equities to drop by 50% from the peak. Again, these engulfing candles leading into very bearish moves, a double engulfing candle at the top, a head and shoulders, a rising wedge. All of these things in a breakdown of this, all of these things pointing very clearly, very strongly to semiconductors continuing to fall, which I will make money on if it keeps going down. TLT, my favorite place to be. This is looking like a bottom. I'm not so sure we're going to head much lower here in TLT. Again, I love treasury bonds right now because of where we are in the cycle with my crystal ball reading, with the yield curve, with the overvaluation of the S&P 500, with the undervaluation of treasuries. There's a mismatch between the pricing of equities and bonds right now, suggesting to me that TLT is a very wonderful place to be. As I think I mentioned on Friday, I did buy more TMF. I think I have 55% of my own portfolio now in various forms of TLT. My favorites are ZROZ and TMF. The way I look at it is I see myself as sort of a more aggressive version of Warren Buffett himself. He's 30% in cash himself, or around 33% in cash. And this is sort of my version of cash, except that you can gain an enormous amount of price gain in the value of bonds as yields are forced to drop, as I expect them to do so at this part of the cycle. I mean, I do always have in the back of my head Benjamin Graham from Security Analysis saying very, very specifically in here, never try to predict interest rates. It's like the dumbest thing you could do. However, it's like exactly what I'm doing with 50% of my portfolio. But he wouldn't argue against the fact that there is such a mismatch of valuation between bonds and stocks right now, which gives me some credibility for this doing well. It's one of these things that's like, it's too tempting for me to not participate in because I can see the potential reward and it looks huge. So, and it's worth the risk to me. So if it doesn't play out to my favor, well, I'll have learned my lesson and I'll move on. Another market catching my eye, DXY, the dollar index, after this massive run to the upside, finally going sideways. Getting nervous, before the election, before the next Fed meeting. What are they going to say? I mean, they'll be able to, they'll be able to open up the doors of any kind of secrecy, any kind of ideas that they've been kind of hiding a little bit. They don't need to hide anymore after the election. And so Thursday could really be very interesting for markets. And the dollar here is just, I think, taking a pause, waiting for what I'm waiting for to see what we might be expecting moving forward, politically and from a monetary policy perspective. As it stands as a simple chart pattern in DXY, this is very obviously a bull flag. So the most expected move to come out of here would be to the upside. A few other details involving the value of TLT and Treasury bonds. The 30-year Treasury yield, TLT itself has a duration, I believe, of 24 years, 0Z 26, I think, if I'm not mistaken. So it's somewhat closely related to the yield of the 30-year Treasury bond yield. And notably, as we've had this climb here, I just want to point out a little pattern here. Let's make it thick so we can see it. Pretty obvious here, right? at the top formation. This is I didn't draw it very good. Hold on. Shoulder to the head and to the shoulder, and now we're down. So I figure this might be actually a head and shoulders top. This might be the top yields, not sure. Again, if it climbs higher, I'll probably get in more. Depends on how, data comes out. You got to be, flexible with your viewpoints as you learn more information about what's going on out there. And then the last piece to what's going on with bonds is that the MOVE index has been climbing higher and higher. And very notably, so the MOVE index is sort of like the VIX for the S&P 500, but this is for the bond market. And when it goes higher, it's expecting larger moves in bonds, and that can be to the upside or to the downside. And if I were to use my crystal ball and all, I'm going to guess that the MOVE index rising here may be sniffing out a large move to the upside in bonds. And I'm trying my best to not just like root for what I own, because like good investors say, don't ever fall in love with a position. Don't fall in love with a bond or a stock, because it won't love you back. It goes up and it goes down, and that's about it. So we'll see how it plays out. Interestingly, the CNN Business Fear and Greed Index is now in fear mode, finally. Mr. Market woke up and is seeing what's going on and realizing what he did. I can't find his pants. If you've heard me talk about him before, I've described him as driving 100 miles an hour the wrong way down a highway with an empty water bottle with something that may not have had water in it, because I think it's insane how overvalued so many stocks have gotten. Not only like, little stocks or even tech stocks, but even the mega caps are like insanely overvalued, suggesting that there's an enormous amount of speculation priced into stocks that just doesn't make sense. It just doesn't make sense. And so whenever there's fear at this point in the game, it makes sense to me. It says to me that Mr. Market is waking up a little bit, opening his eyes. Another chart that's been becoming interesting is Bitcoin. We broke out of this sort of bull flag channel and retested it recently, suggesting that the more likely move for Bitcoin is to move higher from here. But we'll see what happens. I don't like Bitcoin right now myself, because I consider it to be a very, very speculative asset in a time where speculation, should be cooling off here a little bit, a lot. By the way, I am aware that I've turned red, and I have a smart light that just changes colors whenever it wants. I'll try to figure it out. Anyway, for Bitcoin bulls, it could be exciting. We could be heading much higher here. Part of the rumor is Trump being supportive, I think, of Bitcoin, and therefore, if he were to win, that might give the boost that the Bitcoin needs to spike higher. I don't know. If it's a buy the rumor, sell the dip, well, the rumor's already in, so, or not sell the dip, sell the news. And so, if it turns out that way, well, like I said, the rumor's already in, and so the up move has already happened. And so if the news happens, as most people are predicting now that's going to be the outcome, on the news, I might expect Bitcoin to fall here. Any which way about it, I'm not touching it until it becomes very obviously cheap to me. And if Bitcoin has an intrinsic value, it needs to be below the mining cost in terms of electricity. And I believe that's currently still in the $45,000 range per Bitcoin. So you won't see me buying it above $45,000 anytime soon. Last chart of the day, REMX, is just catching my eye, sort of, away from all of this. It's a rare earth and strategic metals ETF. This same exact fund was worth something like $300 or $400 in 2011 and has just been beaten down majorly. The companies in this fund have very low PE ratios. For me, this is one of these Graham areas that is long time underinvested in and is due for a, you know, a release. You know, it's the thought here is like a balloon being held underwater to rise to the surface to get to a somewhat normal valuation. Point is, with the chart today, is I've just been noticing this coiling up pattern. So we're prepared to break out either high or low. I don't know, but it caught my eye. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.